What banks actually do with your money and why it should terrify you. You deposited money into your bank account this morning. You assumed it was sitting there, waiting, safe. It is not. The moment your paycheck lands in that account, the bank does something with it that most people will go their entire lives without understanding. And once you see it, you cannot unsee it. Here is what your bank actually does with your money. Most people think of a bank the way they think of a safe. You put something in, it stays there. You come back later and take it out. The bank is just the building that holds it. That is the mental model almost everyone operates with, and it is completely wrong. Banks are not storage facilities. They are machines. Machines designed to take your money, multiply it, lend it out, and collect the difference. You are not a customer in the traditional sense. You are a source of raw material. Let that sit for a moment. When you deposit $1,000 into a checking account, the bank does not set that $1,000 aside and wait for you to want it back. Instead, it lends most of it out immediately to someone buying a car, to a small business taking out a line of credit, to a family getting a mortgage. Your $1,000 becomes someone else's loan within hours. This is called fractional reserve banking. It means banks are only required to keep a fraction of your deposits on hand at any given time. The rest they deploy. The rest they profit from. For most of modern history, the reserve requirement in the United States sat at around 10%, meaning for every $100 you deposited, the bank was legally required to keep $10 in reserve and could lend out 90. Then, in March of 2020, something changed. The Federal Reserve dropped that requirement to zero. Not 10%, not 5%, zero. American banks are now technically not required to hold any of your deposits in reserve at all. That is not a conspiracy. That is public policy, and you can find it on the Federal Reserve's own website. So what actually protects your money? Two things. First, the FDIC, the Federal Deposit Insurance Corporation, insures deposits up to $250,000 per account per bank. If your bank collapses, the government steps in and makes you whole up to that limit. Second, the assumption that not everyone will want their money back at the same time. That second protection has a name. It is called a bank run. And when it fails catastrophically. In 2023, Silicon Valley Bank collapsed in 48 hours. Not because it was run by criminals, not because of fraud, because too many depositors decided they wanted their money back at the same time. The bank had invested heavily in long-term government bonds, safe assets in theory. But when interest rates rose rapidly, those bonds lost value. And when word spread that the bank was sitting on unrealized losses, depositors panicked. They withdrew $10 billion in a single day. The bank was seized by regulators the next morning. This was not a fringe institution. Silicon Valley Bank was the 16th largest bank in the United States. Now let us go deeper, because fractional reserve banking is only the beginning. When a bank lends out $90 of your $100 deposit, something remarkable happens. That $90 gets deposited into another bank account somewhere. That bank then lends out $81 of it. That gets deposited again and lent out again and again. Economists call this the money multiplier effect. Your original $100 can theoretically ripple through the banking system and create $900 or more in total loans. You deposited $100. The system created $900. Where did the extra $800 come from? It was created out of accounting entries, out of nothing. This is not a metaphor. This is how money works. Milton Friedman, the Nobel Prize-winning economist, spent decades explaining that modern money creation happens primarily through commercial bank lending, not through government printing presses. When a bank makes a loan, it does not move existing money from one place to another. It adds new numbers to a ledger. New money comes into existence at the moment the loan is approved. The Bank of England published a paper in 2014 that made this explicit. The paper, titled "Money Creation in the Modern Economy," stated clearly that the majority of money in circulation is created by commercial banks making loans, not by central banks. Most economics textbooks, the paper noted, do not accurately describe how this works. Most people who studied economics were not taught the truth. You were not taught the truth either. So what does the bank do with this power to create money? It charges you for access to it. The average annual percentage rate on a credit card in the United States is now above 20%. 20%. If you carry a $5,000 balance on a credit card for 1 year, you will pay $1,000 in interest. For money the bank likely created as an accounting entry, for money that did not exist until you were approved for that card. Meanwhile, the average interest rate on a savings account in the United States sits around 0.4%. The bank borrows your money for 0.4% and lends it back to you or to someone else at 20% or more. That gap is called the net interest margin, and it is the engine of modern banking profit. The economist Hyman Minsky spent his career studying this gap. He argued that financial systems are inherently unstable because the profit motive pushes banks to take on more and more risk over time. During good economic periods, banks lend aggressively. Standards drop. Risk accumulates until the system reaches what economists now call a Minsky moment. The point where the debt load becomes unsustainable and everything unwinds at once. The 2008 financial crisis was a textbook Minsky moment. Banks had lent trillions of dollars to home buyers who could not realistically repay, bundled those loans into complex financial products, sold them around the world, and created a global system where no one was entirely sure what anything was worth. The answer, it turned out, was much less than everyone thought. Now here is the part that should change how you think about your own money. Your bank account earns almost nothing. Savings accounts at the largest American banks often pay between 0.01 and 0.5% annually. Inflation, which is the rate at which the purchasing power of your money erodes each year, has averaged around 3 to 4% historically. In recent years, it peaked above 8%. That means every year your money sits in a traditional savings account, it loses real value. Not on paper, in terms of what it can actually buy. $1,000 sitting in a big bank savings account earning 0.5% in a year with 4% inflation is effectively losing $35 of purchasing power. You did nothing wrong. You saved responsibly and you still lost ground. This is not an accident. It is a feature of the system. Banks profit when you keep your money with them and do not ask too many questions. They profit from the spread. They profit from your inertia. So what do you do with this information? First, move your savings to a high-yield savings account. Online banks with lower overhead costs routinely offer annual percentage yields of 4 to 5%, sometimes higher. The FDIC protection is identical to what you get at a traditional bank. The difference is the rate. On a $10,000 balance, the difference between 0.5% and 5% is $450 per year for doing nothing except switching accounts. Second, understand what you are actually doing when you invest. When you buy index funds, which are baskets of stocks that track the overall market, you are not just saving money, you are buying ownership. Ownership in the same companies that banks lend to, invest in, and profit from. You are stepping inside the machine instead of being raw material for it. The S&P 500, an index tracking 500 large American companies, has returned an average of roughly 10% annually over the past century. That beats inflation. That beats a savings account. That builds wealth over time. Third, stop thinking of debt as normal. The bank profits from your willingness to carry a balance. Every dollar of credit card debt you hold is a dollar generating 20% annual returns for someone else. Pay it off aggressively, ahead of everything except an emergency fund. Because no investment you make will reliably return 20%. Eliminating 20% debt is one of the best guaranteed returns available to you. Fourth, stop letting your money sit still. Sitting still is not neutral. In a world with inflation, sitting still is moving backward. Your money is either working for you or being borrowed and worked for someone else. Those are the only two options. Here is what the system does not want you to understand. Banks are extraordinarily profitable precisely because most people never ask what happens after the deposit. They trust the building. They trust the number on the screen. They assume the system is working for them because it is working near them. But a machine is not on your side. A machine does what it is built to do. You deposited money into your bank account this morning. You assumed it was sitting there, waiting, safe. Now you know it is not sitting still. Now the question is whether you are.